Financial markets in Europe and Asia have plummeted as tensions between Russia and Ukraine escalate, suggesting investor concerns about the wider economic consequences of a future conflict. Stay tuned for updates on the stock market meltdown caused by the crisis between Ukraine and Russia. Without further ado, let's get started. On Monday, the value of London's top 350 listed firms was reduced by £42 billion as rising concerns of a Russian invasion on Ukraine caused a global share sell-off. As geopolitical concerns propelled oil prices to 7-year highs, European stock markets tumbled sharply, tracking losses in Asia-Pacific markets. The FTSE 100 index fell 1.7% or 129 points to settle at 7532, the most since the crisis hit markets 3 weeks ago. IAG, the parent company of British Airways, lost 5.6%. Financial companies were also affected, with Barclays down 5.1% and Lloyds Banking Group and NatWest down about 4.1%, as the blue chip index lost more than £34 billion, dropping off a 2-year high reached last week. The FTSE 250 index of mid-sized firms fell 1.95%, or £7.7 billion, with Wizz Air falling 6.3% and Carnival falling 4.8%. Heavy rain fell over Europe, raising fears that Russia's invasion of Ukraine will impair electricity supply to the continent. The DAX in Germany and the FTSE MIB in Italy both fell 2%, while the CAC in France fell 2.3%. The sell-off occurred as German Chancellor Olaf Scholz visited Kiev on Monday and will fly to Moscow on Tuesday, warning that a Russian strike would result in tough sanctions being applied immediately. Just as the COVID storm seemed to be calming down, the growing expectations of an invasion of Ukraine is the new threat that has investors worried, said Susanna Streeter, a senior financial and markets analyst at Hargreaves Lansdowne. Energy markets are clearly on edge, and if supplies are threatened, there is a risk that oil prices will skyrocket, putting additional pressure on companies. Expectations of a Russian invasion of Ukraine pushed the price of Brent crude oil above $96 per barrel for the first time since September 2014, before falling down to $94.50. Analysts have warned that if tensions build, oil may soon break the $100 threshold, with the price of oil having already jumped more than 20% since the beginning of 2022. Natural gas prices jumped as well, with the UK contract for the next day's supply rising 4%. Russia is responsible for 1/3 of Europe's natural gas output and around 10% of world oil production. According to Craig Erlam, an analyst at brokerage Oanda, the Ukraine situation has expedited the trend in crude prices near $100 per barrel since the oil market is extremely tight at the moment, and the OPEC oil cartel has fallen short on quotas. Demand growth is strong and OPEC Plus is failing to meet output targets. Rather than closing the gap, it is growing. We don't need OPEC Plus to broaden objectives. It's time for Saudi Arabia to take unilateral action, which allegedly has the potential to reduce constraints. Until then, the only chance is nuclear agreement between the United States and Iran. In the absence of either, triple-digit oil appears quite likely, Erlam warned. The rise in oil prices promises to drive up gasoline prices in the coming weeks, with UK petrol prices reaching all-time highs last weekend. The big issue for consumers will be the uncertainty surrounding rising energy prices. How far can they go? How much extra pain can they inflict at a time when many people are already struggling with rising costs? DANNI HEWSON, A.J. Bell financial analyst, asked. While the price of a barrel of oil has fallen from earlier highs, that will be of little comfort to drivers heading to the pumps this evening and wincing at the numbers displayed on the screen. Fearful investors flock to safe haven assets such as the US dollar, sending the pound to a 1-week low of roughly $1.352. European share prices fell in response to a sell-off in Asia. The benchmark Hang Seng Index in Hong Kong sank nearly 1.4%, while Japan's Topix and South Korea's Kospi fell 1.6%. Stocks fell in New York, compounding losses from Friday night when the U.S. warned of a very distinct possibility of a Russian invasion of Ukraine in the coming days. At lunchtime, the Dow Jones Index of 30 main U.S. businesses was down 0.5%, while the tech-focused NASDAQ has recovered around 0.6%. Markets are bracing for the possibility of war in Europe, which adds to the complex of issues driving uncertainty and volatility in global markets right now, said Kyle Rhoda, an analyst at IG. The concern is that if sanctions are imposed on Russia, the impact on fragile energy markets, European economic growth, and the broader financial system will be severe. As investors continue to focus on potential of a Russian invasion of Ukraine, RBC Capital Markets warn that stock market declines before conflict tend to resemble growth scares. There is no past conflict in Russia-Ukraine that provides a good template for how low stocks could trade if an invasion occurs. RBC analyst led by CALVASINA, head of U.S. equity strategy, said in a research note Monday. However, we've noticed that stock market declines during the two Iraq wars were similar to the kinds of drops we see during recessions and growth scares. According to RBC analysts, the S&P 500 index plunged more than 19% from peak to trough during the 1990 Gulf War, a drop that was also correlated with a recession that year. The 33% decrease in the U.S. stock index during the Second Iraq War in 2003 occurred when investors were also grappling with the aftermath of the tech bubble, as well as the accounting scandals that marked the early 2000s. They noted, the S&P 500 index is down so far in 2022, owing to market concerns about increasing inflation and anticipation that the Federal Reserve would try to combat it this year by tightening monetary policy. The Fed is mostly priced into the S&P 500, RBC analysts said, but a Russian invasion of Ukraine may not be and currently presents one of the stock market's key risks. Market concerns about Ukraine appeared to relax somewhat Monday as Russian Foreign Minister SERGEI LAVROV urged that Moscow should continue to communicate with NATO and the European Union during a meeting with the Russian President Vladimir Putin. We continue to believe that the lows of January 27 have a good chance of holding assuming that a recession is avoided, RBC analyst stated. However, if we are wrong, a growth scare equal to 15% to 20% decline from this year's peak is probably the right way to gauge potential downside risk. According to Dow Jones market data, the S&P 500 closed Friday around 7.9% on January 3rd. According to FactSet data, the SIBO Volatility Index VIX, negative 1.67%, was trading around 30 on Monday morning. This is up from around 27 on Friday and above the long-term average of slightly around 20. The escalation of Russia-Ukraine tensions comes at a time when the stock market is already vulnerable due to inflation concerns and the possibility of Federal Reserve tightening. George Ball, chairman of Houston-based investment company Sanders Morris Harris, said in an emailed statement Monday. If an armed conflict between Russia and Ukraine is avoided, a short-term relief rally is likely, Ball said. However, there are still too many worries on the horizon for any type of longer-term upward move higher in stocks. It's time for investors to start raising money. An investor who typically holds 5% of their portfolio in cash, with the remainder in stocks and bonds, should increase their cash position to 10 to 20% of their portfolio, with the remainder divided in the normal 60-40 fashion between stocks and bonds, says Ball. When markets are volatile, cash is the ultimate king, Ball added. That's it for today's video. Thank you for watching. Don't forget to like and subscribe.